Hello, everyone. Welcome to Talk Talk Speak podcast today. We are plunging into the intriguing realm of safe haven currencies.
Right. The places money runs to when things get shaky.
Exactly. When the world throws us curveballs,
Yeah.
Economic wobbles, political storms, market jitters, investors often look for shelter. Currencies they believe will hold their value.
And we usually think of the US dollar, the Swiss franc.
The Japanese yen, and maybe even gold.
Yeah.
Typically these come from countries with stable governments, stable economies, right?
And importantly, deep financial markets where you can easily buy and sell.
Definitely. The dollar gets a boost from being the global reserve currency. Switzerland, well, has that long history of neutrality.
And Japan's got those persistently super low interest rates, which is kind of the core of what we're digging into.
That leads us right there, yeah. To the heart of our deep dive today, the safe haven reputation of the Japanese yen. I mean, it's the third most actively traded currency globally.
And we see this pattern again and again. It tends to strengthen when global markets are in turmoil.
But here's where it gets really interesting. There's a real puzzle here.
Yeah, it's a bit of a paradox, isn't it?
It totally is. Japan itself has faced significant long-term economic challenges, those famous lost decades, persistent deflation, huge government debt.
Stuff that would normally scream safe haven.
Yeah, exactly. Yet, despite all that, the yen often strengthens precisely when global risks are rising. It's almost like its strength is more about reacting to global problems than reflecting a strong Japanese economy.
It's quite counterintuitive.
Very curious. So our mission today is to unravel this enigma. We're going to explore where this safe haven status came from, the mechanics behind it.
How it actually performed during big crises.
Right, over the last 30 years or so, roughly 1995 to 2025, and look at the impact on Japan itself.
And we've got 4 key crises lined up.
Yep, we'll focus on 4 periods. The Asian financial crisis, 1997-98, then the global financial crisis, 2008-09.
The European sovereign debt crisis that followed, 2010-12.
And finally, the more recent disruption, the COVID-19 pandemic and its aftermath, so 2020 to 2022.
Okay, quite a journey through recent financial history.
It should be fascinating. So let's get started on this deep dive into the curious case of the yen as a safe haven.
Okay, let's unpack this. How did the yen even get this reputation? It wasn't born this way.
Right, it had to evolve.
Exactly. If you look back after World War II, under the Bretton Woods system, fixed exchange rates tied to the dollar.
Ah, yes, setting up the post-war order.
Right. The yen was deliberately kept undervalued then to help Japan's exports, help it rebuild. Its international role was pretty limited.
So policy choices right from the start shaped its path.
Definitely. The big shift came in 1973 when that fixed system broke down and we moved to floating exchange rates.
The currencies could find their own levels based on market forces.
Pretty much. And as Japan's economy boomed and its trade surpluses grew, especially with the U.S., the yen started to rise. We saw a big appreciation between 73 and 78, for example.
Okay, so economic success started pushing it up.
Then came the Plaza Accord in 1985. Basically, the big economies agreed the U.S. dollar was too strong and needed to come down.
Which meant the yen had to go up
sharply. And what's fascinating is this rapid appreciation happened right alongside Japan's massive asset bubble in the late 80s. Shows how currency moves in domestic markets can get tangled up.
Ah, the infamous bubble era.
Indeed. And here's where it gets really relevant for its safe haven status. When that bubble burst in the early 90s, well, Japan entered the lost decades.
Persistent deflation, falling prices.
Exactly. And to fight that deflation, the Bank of Japan started cutting interest rates, eventually hitting near zero around 1999. They basically pioneered the zero interest rate policy, or ZRAP.
So a major domestic problem deflation led to this policy cornerstone.
Precisely. This long-term, ultra-low, sometimes even negative interest rate policy became fundamental to the yen's safe haven role later on. A domestic struggle laid the groundwork, sort of accidentally, for its international status.
Right, okay. So this prolonged period of ultra-low rates seems absolutely central. How exactly does that make a currency a safe haven? It seems a bit backwards.
It does seem backwards, but it's connected to something called the carry trade. It's fascinating, actually.
Okay, explain the carry trade.
Because Japan's interest rates were practically zero for so long, the yen became super cheap to borrow.
Like getting a loan for almost nothing.
Exactly. So investors, big institutions, even retail investors, the famous Mrs. Watanabe archetype, would borrow loads of this cheap yen.
Okay.
Then they'd sell that yen, buy a currency with higher interest rates like the Australian dollar or back then even the US dollar, and invest in assets, their bonds, whatever, earning that higher yield.
Pocketing the difference in interest rates, the
Yeah,
carry.
precisely. The key insight here is how one major economy keeping rates super low can fuel these huge global investment flows. It makes the yen a funding currency.
Okay, so that explains why people borrow yen in normal times. But how does that make it safe in a crisis?
Ah, here's the twist. When global markets go haywire, a big crisis hits, investors panic, they want less risk.
They scramble for safety.
Right. And what do they do with those carry trades? They unwind them
Right.
quickly.
Right.
They sell those foreign assets they bought, the ones in Aussie dollars or US dollars,
Okay.
and they have to buy back the yen they originally borrowed to pay back their cheap yen loans.
So a sudden rush to buy yen.
Exactly. This sudden surge in demand for yen drives its value up, sometimes sharply. It becomes the storm anchor. The more volatile things get globally, the more these trades unwind, the higher the yen can go.
Wow. So its weakness, the low interest rate, becomes its strength in a crisis. It's, counterintuitive, but makes sense now.
It's a core mechanism.
Borrow low, invest high, then panic and run back to the low-cost currency, boosting it.
Yeah.
Okay. What else is going on? That can't be the whole story.
No, it's not. If we connect this to the bigger picture, Japan's massive net international investment position is crucial.
Meaning all the assets Japan owns abroad?
Exactly. Japan has been the world's biggest net creditor for ages. They own a huge amount of foreign assets, stocks, bonds, factories. We're talking over 470 trillion yen in 2023. Staggering amount.
Wow. Okay, so how does that play in?
Well, during a crisis, there's a tendency for Japanese institutions and individuals to repatriate some of that money, bring it back home.
Sell the foreign stuff and bring the money back into yen.
Precisely. They sell those foreign stocks and bonds, convert the proceeds back into yen, again, increasing demand for yen, pushing its value up. It's another source of buying pressure in bad times.
So money flowing back home reinforces the safe haven effect.
Yes. And what's also important is the income from those overseas investments. Dividends, interest payments, that flows back to Japan regularly.
Like a steady stream of foreign earnings.
Right. And this income helps Japan maintain a current account surplus, more money flowing in than out overall, even when its trade balance, exports minus imports, has recently turned negative because of high energy prices and stuff.
So even if they import more goods than they export, the investment income helps keep the overall balance positive.
Often, yes. And that ongoing inflow creates a sort of underlying structural demand for the yen, reinforcing its stability. It helps compensate for those domestic economic weaknesses we talked about. It's like a reinforcing cycle.
So Japan's financial strength abroad acts as a kind of buffer or safety net for the yen, even if the domestic economy is sluggish.
That's a good way to put it. Then there's the factor of relative stability, political and economic stability.
Even with slow growth.
Yeah, despite the slow growth, Japan is generally seen as a very stable, mature place. Long-standing democracy, solid legal system, social order, pretty predictable policymaking. At least that was the perception for a long time.
Okay.
And in times of global chaos, that stable stagnation, as some call it, can actually look pretty attractive. Investors might prioritize just avoiding losses and volatility over chasing high growth somewhere riskier.
So predictability becomes a valuable asset in itself?
Exactly. And maybe Japan's geography plays a small part too. Being relatively isolated might reduce the direct impact from some regional conflicts. It's not about being dynamic. It's about being perceived as reliable when everything else feels uncertain.
Got it. Reliability over speed.
And don't forget the basic plumbing. Japan has huge, highly developed, very liquid financial markets.
Meaning it's easy to trade large amounts.
Yes. The yen is the third most traded currency, remember? That deep liquidity means investors can buy or sell massive amounts of yen quickly, efficiently, without moving the price too much against them, especially for hedging. That's crucial.
You need to be able to get in and out easily if it's going to be a safe haven.
Absolutely. High liquidity is key. A less liquid currency just wouldn't work as well.
Okay. Any other factors?
Well, there's market psychology, sort of a self-fulfilling prophecy. Because the yen has been seen as a safe haven for so long. When markets get jittery, people just expect it to rise, so they start buying it in anticipation,
Which then pushes the price up.
confirming their initial expectation. It's a feedback loop built on history and belief. What traders believe can become reality, at least for a while.
Fascinating. Okay, so we've got the history, the low rates fueling carry trades, the massive overseas assets coming home, relative stability, liquid markets, and market psychology. That's quite a combination.
It really is. It explains why, despite domestic issues, the yen often behaved this way.
Right. So now let's put it to the test. How did the yen actually perform during those big global crises we mentioned, starting with the Asian financial crisis back in 97, 98?
Okay. Yeah, for each of these, as you said, we'll look at the background, the yen's moves, capital flows, the hit to Japan's economy, and what we learned.
Sounds good. So the Asian crisis started in Thailand, right?
Yep. Kicked off with the devaluation of the Thai baht, spread quickly across Southeast Asia, revealed a lot of underlying problems, weak banks, too much borrowing in foreign currency, that kind of thing. The IMF had to step in big time.
And the yen, did it act like a regional safe haven?
Well, here's the interesting thing. Not really, not at first. Its behavior was complex.
Oh, how so?
Before the crisis really hit, the yen had actually been weakening against the dollar. And it kept weakening in the initial phase, hitting around 147 yen to the dollar by August 98.
So it went the wrong way initially.
From a safe haven perspective, yes. It only really started to appreciate significantly later in the crisis, especially after the Russian financial crisis in 98 really spooked global markets. Then it strengthened back towards, say, 115, 120 against the dollar.
So it wasn't the first port of call in that storm. Why not?
That's the key question, right? It highlights the conditionality. Japan itself was quite fragile economically back then. Its banks were heavily exposed to those struggling Asian economies.
Ah, so Japan was too close to the fire, economically speaking.
Exactly. And Japan was grappling with its own banking problems at home, leading to the Japan premium, where Japanese banks had to pay more to borrow internationally because people were worried about them.
So domestic weakness and direct exposure kind of suppressed the safe haven effect.
It seems so. Capital flow data is tricky for that period, but it suggests maybe initial outflows from Japan due to these worries, followed by some inflows later when the crisis became a truly global risk event, not just Asian.
And what did this whole episode do to Japan's economy?
It hit pretty hard. GDP growth slowed down sharply. Exports to the rest of Asia slumped. The strain on the financial system got worse. We saw some bank failures. Deflationary pressures picked up. Unemployment rose.
Not good. And the Bank of Japan.
Well, their rates were already very low, so they didn't have much room to cut further with traditional tools. They focused more on providing liquidity to banks and even intervened in the currency market with the U.S. to try and stabilize things.
So the main takeaway from the Asian crisis is the yen's safe haven status isn't automatic. It depends on Japan's own health and its connection to the crisis.
Precisely. The safe haven characteristics were kind of muted initially because Japan itself was vulnerable and deeply tied to the region. It only really kicked in when the fear went global.
Okay, now let's contrast that with the global financial crisis, the GFC, in 2008-2009. That started in the U.S. subprime mortgage market.
Right. A very different origin, centered in the heart of the global financial system. Lehman Brothers collapsing, global credit markets freezing, huge government bailouts. A massive systemic crisis.
And the yen's reaction this time.
Much more like the textbook safe haven, we saw strong, sustained appreciation. Against the U.S. dollar, it went from around 124 before the worst hit, down below 90 yen to the dollar. Big move. Also strengthened significantly against the euro.
Wow. So a classic flight to safety. What drove that?
Several things firing at once. Definitely heightened global risk aversion investors just wanted out of anything risky. Crucially, that forced unwinding of yen carry trades we talked about earlier.
People scrambling to pay back those cheap yen loans.
Exactly. And likely some repatriation of Japanese capital, too. Japanese investors bringing money home from turbulent overseas markets.
Okay, that fits the safe haven script perfectly. But what about the impact on Japan's economy? They weren't directly exposed to subprime mortgages as much as the U.S. or Europe, right?
Less direct exposure, true.
Yeah.
But the impact was still severe, mainly through the collapse in global trade and plummeting confidence.
So the global recession dragged them down hard.
Very hard. Japan fell into a deep recession. Exports absolutely collapsed, historically bad numbers. Deflation got even worse. CPI inflation fell sharply negative. Unemployment shot up. Corporate profits tanked.
Ouch. And the BOJ's response? Rates were already near zero.
Right, so they went full-on unconventional. Massive quantitative easing, buying up government bonds and other assets, buying commercial paper and corporate bonds directly to help companies get funding, setting up dollar swap lines with the Fed to ensure access to U.S. dollars. They threw the kitchen sink at it, policy-wise.
But here's that paradox again. The strong yen must have hurt them.
Absolutely. That's the double-edged sword. The yen surge, driven by global panic, made things worse for Japan's
Yeah,
economy.
so?
It hammered exporters by making their goods way more expensive overseas. It squeezed their profits. It intensified deflation by making imports cheaper. It basically counteracted a lot of what the Bank of Japan was trying to achieve with its easing policies.
So the safe haven status itself became a major economic headwind for Japan during the GFC. The global medicine was poisoned locally.
That sums it up pretty well. A classic safe haven reaction, but with painful domestic consequences.
Okay, let's move to the next crisis. The European sovereign debt crisis, roughly 2010-2012, started with Greece, then spread.
Yep, spread to Ireland, Portugal, Spain, Italy. The PIGS, as they were unfortunately nicknamed, fears about Eurozone stability, potential breakup, lots of emergency summits and rescue packages from the EU, ECB, IMF.
And the yen, did it play the safe haven role again?
It sure did. Another round of strong, persistent appreciation. Against the US dollar, it actually hit record lows below 80 yen, even touching 75 point something briefly, and it gained significantly against the euro as investors fled euro assets.
So at that flight to quality demand was driving it again.
Primarily, yes. People wanted out of euros, and the yen, along with the US dollar, were major beneficiaries. Carry trade unwinding might have been less of a factor this time, as global rates were generally low after the GFC, but the yen's ultra-low rate still made it a default funding currency to some extent.
And capital flows. Money moving into Japan.
Likely, yes. We probably saw continued net inflows, especially into Japanese government bonds, JGBs, from European investors looking for safety. Japanese investors likely cut back their European holdings too.
And JGB yields stayed low despite Japan's massive debt.
Remarkably stable. That was partly due to those safe haven inflows, but also because JGBs are overwhelmingly held domestically by Japanese institutions and households who are less likely to panic sell compared to foreign investors.
Interesting. Okay, impact on Japan's economy this time. They were still recovering from the GFC.
And then they got hit by the massive earthquake and tsunami in March 2011, so a really tough period. The strong yen from the European crisis added another layer of difficulty.
How did it affect the recovery?
It definitely slowed things down. Hampered exports, again, due to the lack of price competitiveness. It deepened deflationary pressures. CPI stayed negative. Unemployment remained sticky. Exporters' profits got squeezed.
So similar negative effects as during the GFC from the strong yen. What did policymakers do?
The BOJ kept policy ultra loose, sticking to zero rates and expanding asset purchases through what they called comprehensive monetary easing. The government also stepped into the FX market again, trying to sell yen to weaken it, though these interventions often have limited lasting impact against strong market flows.
So the European crisis really cemented the yen's safe haven status after the GFC, but also highlighted the policy headache it created for Japan.
Absolutely. The yen's strength was driven entirely by external fears, completely disconnected from Japan's own economic situation, which was struggling with deflation and post-disaster reconstruction. It really showed how global forces could undermine domestic monetary policy efforts at the zero lower bound. Policymakers were almost forced to focus on managing the exchange rate itself, not just domestic conditions.
A real policy bind. Okay, it feels like for decades, a strong yen, often driven by these safe haven flows, was more of a curse than a blessing for Japan's economy.
Often, yes. It created persistent headwinds.
Which brings us to the most recent period, the COVID-19 pandemic and its aftermath, 2020-2022. You said earlier this felt like a different story for the yen.
Oh, dramatically different. This period really challenged the traditional narrative.
Okay, set the scene. Unprecedented global shock. Lockdowns, supply chains snarled.
Massive government spending and central bank easing everywhere initially. But then from 2022, a surge in global inflation and aggressive rate hikes from the Fed, the ECB, other major central banks, while the Bank of Japan mostly stayed put.
Right. And the yen's performance during all this.
Here's a big break. We saw a brief sort of knee-jerk safe haven appreciation right at the start of the pandemic in early 2020. The yen strengthened a bit.
Okay, standard reaction initially.
But that reversed quickly. What followed was a long, sharp depreciation against the US dollar, falling from around 103 to briefly below 150, and a less dramatic but still significant weakening against the euro.
Wow, completely the opposite of the GFC or European crisis playbook. What on earth was driving that during a time of massive global uncertainty?
This is absolutely key. The number one factor was the huge widening gap in monetary policy.
The Fed and others hiking rates aggressively, while the BOJ kept rates near zero or negative.
Exactly. The Federal Reserve, the ECB, they slammed on the brakes, hiking rates fast to fight inflation. The Bank of Japan, worried about killing a fragile recovery and slipping back into deflation, kept its foot firmly on the accelerator negative rates, yield curve control, YCC, capping bond yields, ongoing asset purchases.
So the interest rate difference became enormous.
Massive. And that made holding yen incredibly unattractive from a yield perspective. Why hold a zero-yielding currency when you could hold dollars earning 4 or 5%? It actively encouraged investors to sell yen and buy higher-yielding currencies, essentially, restarting yen carry trades, but driven by outflows this time.
So the interest rate differential just overwhelmed any safe haven tendency.
It appears so. That was the dominant force. But there were other factors, too.
Like what?
Japan's trade situation worsened dramatically. Global energy and raw material prices soared after the pandemic and the war in Ukraine. As a major importer of these, Japan's import bill ballooned.
Leading to big trade deficits.
Yes, large and persistent trade deficits. That means Japanese companies constantly needed to sell yen and buy foreign currency just to pay for imports, creating steady downward pressure on the yen.
Okay, so weak trade fundamentals added to the pressure.
And also, the yen's image as a low-inflation, stable currency got a bit dented. Japan did see inflation pick up, hitting over 2%, even 3–4% at points low by Western standards, but high for Japan. That eroded the stable value argument a bit.
And the economy itself wasn't exactly booming.
Right. Japan's economic recovery from the pandemic was relatively slow and uneven compared to some others. That also probably reduced its appeal as a haven. Put it all together, and many analysts started asking seriously, is the yen losing its safe haven status?
So the traditional mechanisms carry trade unwinding, driving yen up. Repatriation seemed to get flipped or overwhelmed in this unique environment.
It looks that way. We likely saw significant net capital outflows from Japan in 2021–2022 as investors chased higher yields elsewhere, especially in the U.S. The balance of payments data confirm this. The current account surplus shrank dramatically due to the trade deficit, and portfolio investment showed net outflows, consistent with a weakening yen.
And the impact on Japan's economy during this weird period. The weak yen must have had different effects compared to the strong yen episodes.
Very complex picture. The initial COVID shock caused a sharp recession in 2020, of course. The recovery was slow.
Did the weak yen help exports?
Theoretically, it should boost competitiveness, but the picture was muddied by weak global demand in some sectors and ongoing supply chain issues. Maybe it helped some exporters, but it wasn't a simple boom.
And inflation finally returned to Japan?
Mm.
But maybe not the good kind.
Exactly. The CPI inflation finally got above the BOJ's 2% target, breaking decades of deflation or near zero inflation. But it was largely cost-push inflation driven by those high import costs from energy and the weak yen itself, not demand-pull inflation from a strong domestic economy.
So it squeezed households.
Yes, it eroded purchasing power because wages didn't keep pace. So while the BOJ finally saw some inflation, it wasn't necessarily the healthy kind they'd been hoping for.
And the BOJ just stuck to its guns on ultra-loose policy through all this.
Pretty much. They tweaked the YCC band slightly, but fundamentally kept the framework, creating that stark contrast with global tightening. They even intervened in the FX market in late 2022, this time buying yen to try and slow down its rapid fall. The opposite of past interventions.
It really sounds like the pandemic era flipped the script entirely for the yen.
It really did. It showed that extreme global monetary policy divergence and major shocks to trade can absolutely overwhelm the traditional safe haven mechanisms. The yen behaved much more like a funding currency sensitive to interest rates. It definitely raises questions about whether something fundamental has changed.
Okay. So taking all these crises together, the Asian one where it faltered, the GSC and European ones where it was a strong haven but hurt Japan, and COVID where it weakened. What are the big picture impacts of this safe haven status on Japan's economy over these 30 years?
Well, it's clear the consequences of these yen swings, often driven by global fear, have been significant and have been, frankly, negative for Japan itself.
Especially the appreciation phases.
Yes. During those strong yen periods, GFC, European crisis, the main effects were negative. Weaker exports, squeezed profits for companies selling abroad, worse deflation, a drag on GDP growth. And, as we discussed, it tied the hands of the Bank of Japan.
Any positives from a strong yen? Lower import costs, maybe.
Minor positives, yes. Lower costs for imported goods and energy, increased purchasing power for Japanese tourists or companies buying assets abroad. But these were usually outweighed by the negatives, especially when the economy was already struggling with deflation.
And the depreciation periods, like recently or early in the Asian crisis.
Those have a different mix. Potential positives. Boosted export competitiveness, maybe it helps tourism, increases the yen value of profits earned overseas, potentially helps ease deflationary pressures.
But downsides, too.
Definitely. Higher import costs hitting consumers and businesses, eroding real incomes if wages don't rise, worsening terms of trade, could potentially spark worries about capital flight if it goes too far, and it can create international friction sometimes.
And throughout all this, the Bank of Japan is caught in the middle.
Absolutely. They've been stuck at the zero lower bound for rates for much of this period, limiting their conventional options.
Hence all the unconventional policies, QE, YCC, negative rates.
Right. Quantitative easing, yield curve control, negative interest rate policy, forward guidance, even buying ETFs. They've used a huge toolkit. But the debate continues about how effective these really were in boosting growth, and especially inflation expectations sustainably. Success on inflation was elusive for a very long time.
And the exchange rate constantly complicates things.
Massively. Yen appreciation driven by safe haven flows directly counteracts their efforts to stimulate the economy and create inflation. Interventions to weaken the yen often had limited effect. Conversely, the sharp depreciation recently created a dilemma: stick with easing for the economy, or tighten to support the currency and fight imported inflation.
It sounds like a perpetual tightrope walk.
It really has been. And you could argue this long period of unconventional policy created a kind of policy inertia, making it really hard to eventually normalize policy without causing major disruption, especially with such high government debt. Sticking with YCC and negative rates in 2022, while everyone else hiked, showed that fear of derailing the exit from deflation.
Are there longer-term structural impacts from all this volatility?
Probably. Repeated bouts of yen strength might have pushed more Japanese manufacturers to move production offshore, build factories abroad, just to avoid the exchange rate risk. That could contribute to a hollowing out of domestic industry, alongside Japan's already significant foreign direct investment.
Makes sense. Hedging by relocating.
And the whole environment, long stagnation, deflation mindset, unpredictable currency moves might have encouraged Japanese companies to be quite conservative, hoarding cash, being reluctant to invest aggressively or raise wages, focusing on cutting costs rather than expansion.
So the safe haven status interacts with and potentially worsens Japan's other big challenges: aging population, weak domestic demand, high debt.
It definitely adds another layer of complexity to managing the Japanese economy. It's not operating in a vacuum.
Okay, so bringing it all together as we look forward, has the yen's traditional safe haven role fundamentally changed? Is the narrative broken?
That's the multi-trillion yen question, isn't it? The 2020-2022 experience, that big depreciation despite global risks, is powerful evidence that something has shifted, or at least that the old rules don't always apply.
What are the key challenges now to that old narrative?
Number one is that extreme monetary policy divergence we saw. If the BOJ stays easy while others are tight, rate differentials can dominate. Number two, Japan actually having some domestic inflation, even if import-driven, changes the stable value perception and means real interest rates are deeply negative, making yen less attractive to hold. Number three, the shift to a trade deficit weakens that natural underlying demand for yen from trade surpluses. And number four, carry trade dynamics might be different now. The huge rate gap might encourage outflows more consistently, not just crisis-driven inflows from unwinding. And if when the BOJ does normalize policy, that completely changes its role as the cheap funding currency.
How did the yen stack up against other safe havens like the dollar or Swiss franc recently?
It underperformed significantly. The US dollar strengthened massively, benefiting from its reserve status and those aggressive Fed rate hikes. The Swiss franc held up relatively better than the yen, perhaps helped by Switzerland having lower, more stable inflation, and a central bank that did start tightening, albeit less aggressively than the Fed. Gold's relationship is always complex, sometimes correlated, sometimes not.
So it really depends on the specific environment, especially interest rates and inflation.
Exactly. Recent events show that safe haven attractiveness isn't fixed. It depends heavily on the macro backdrop, especially those interest rate and inflation differentials. Relative appeal matters.
So looking ahead, what are the possible scenarios for the yen? Will it still be a haven sometimes?
I think one plausible scenario is, let's call it a sustained but sensitized safe haven attribute, meaning, yes, in moments of extreme global panic, the yen might still appreciate due to repatriation or maybe some residual carry trade unwinds,
Not it.
but its sensitivity to interest rate differentials will be much, much higher than before. If the BOJ stays super easy while global rates are high, any safe haven rally might be quite limited or short-lived. If global rates fall closer to Japan's, then maybe the haven aspect could reassert itself more strongly in a crisis.
So conditional haven status.
Yeah.
What's another possibility?
Scenario 2 would be a more structural weakening of its safe haven role.
What could cause that?
If Japan sees more persistent domestic inflation that forces the BOJ into significant sustained policy normalization, raising rates meaningfully, or if those trade deficits become entrenched long-term, or if shifts in global finance, maybe new regulations or the rise of other funding currencies, reduce the yen's unique role in carry trades.
And in that scenario,
Then the yen's value might become much more driven by Japan's own domestic economic fundamentals, growth, inflation, policy decisions, rather than just being a reflex reaction to global risk sentiment. More like a normal currency, perhaps.
okay. So the big takeaway here seems to be that the yen's safe haven status, while historically really important, isn't some absolute law of finance. It's conditional, it's evolving.
And it's currently being significantly challenged, or at least reshaped, by these huge global monetary policy shifts and changes in Japan's own economic landscape, like trade and inflation.
The COVID era really put that evolution into sharp focus.
Absolutely. It was a real stress test, and the results were different from previous tests.
Which leads us to a final thought for you, our listener. Has our traditional understanding of the yen as an automatic go-to safe haven fundamentally changed? And if so, what does that mean for global financial stability, for your own investment strategies, perhaps, in the years to come? Something to definitely mull over.
It has potentially big implications.
Thank you for joining us. See you next time.